Stocks are down in early trading as investors assess the long-term impact of tariffs and the uncertainty surrounding the entire tariff story. Our next guest is betting outside the U.S. as he expects American exceptionalism to be eroded. Let's bring in a familiar face to viewers of this program. Chhad Aul is Chief Investment Officer and Head of Multi-Asset Solutions at Sun Life's SLGI Asset Management. Chhad, thanks for coming in.
Great for being here.
So, how much of a change, if anything, was yesterday's 90-day hit the pause button move by Donald Trump? Does it fundamentally change your outlook on the markets?
Well, I think it takes the worst case scenario off the table, at least for now, right? And we got a sense of, okay, where's the pain point? A lot of people were looking for is there a Trump put in terms of the equity market? Didn't really seem like it, but I think, what happened overnight in Treasury markets the night before, where we saw the 10-year Treasury yield flirt with 4.5%, we're starting to see stresses in the bond market pointing to greater deleveraging, et cetera. I think that we got the sense that there is a bit of a put out there. It's probably more in the fixed income market. It's more around financial stability, and that's where we had the Treasury Secretary, I think, really amping up, trying to rein in the president. So I think it does at least take the worst case scenario off the table for now. We'll get a little bit of a reset, probably overshot yesterday. It'll take days, I think, for this volatility to even cool down in the short term. But the longer term damage, I think, is done. And that's from that perspective of U.S. exceptionalism. U.S. consumers are going to be feeling greater uncertainty. And U.S. trading partners, they're going to look to pivot to new export markets. Investors globally are going to look to pivot in terms of where they're investing their next dollar as well.
The worst case scenario off the table for now. How important are the two words "for now" to investors? They realize surely that this could all come back again. Absolutely.
Whether it's at the end of this 90-day period or at some point in between, this is a truly exceptional period in that we have a policymaker, in this case within the White House, that is not looking to, in fact, sort of backstop economic concerns, but has actually been, let's call it, the source of some of the anxiety and the volatility in markets. It's very hard to predict where things may come back into play from here. So, we're generally, like I said, close to neutral in terms of overall risk positioning in the portfolio, given also how far we've fallen. But we are looking for those opportunities to incrementally shift away, certainly from an over-reliance that many investment portfolios have within the U.S. I think broader diversification has worked so far this year. Getting into that global diversification, looking for high-quality bonds to provide downside protection as these risks may well emerge. The best way to get through this.
Many of our viewers will have significant U.S. exposure in their stock portfolios, and as you've just referenced, and I'd like you to expand on it, you're looking to other geographies now. You're looking to de-emphasize, to some degree at least, U.S. equities.
Yeah, and if you look at before things really broke loose on Liberation Day, we'd already had a scenario where, with a lot of trade uncertainty, ex-U.S. markets were doing a lot better, right? So certainly up for the year. If you look at markets in Europe and in the Far East, et cetera, Canadian equities as well holding up relatively better. So that theme, I think, is going to persist. So we're looking at, again, broadly outside of the U.S., looking for those opportunities. We're not walking away from the U.S. I would have some preference for more defensive positioning in the U.S. market. So things like healthcare, like consumer staples. There is certainly still a place within a portfolio.
Interesting to see, as we just did, those European markets surging higher as North American markets decline. What are your thoughts on European equities?
Yeah, certainly still a little bit of a catch-up from yesterday. Of course, European markets were closed when the news hit, and you've seen the sort of roundabout as we go. So, like I said, as the dust settles and the various markets kind of catch up to the latest news, we're still probably at a point where there's been some significant outperformance so far this year in global markets outside of the U.S. And I think that's a theme that will incrementally persist. So I think looking at those opportunities, you're seeing weakness in the U.S. dollar as well. So again, coming into this year, the thought that the U.S. could fight a trade war and you have America first persist as a theme, a stronger U.S. dollar, stronger U.S. equity markets, that was already turned on its head in the early months of this year. And I think that's a theme that will continue to persist as some of the lasting damage of this, just how this trade war has been conducted and the uncertainty created, will continue to be priced into markets globally.
although as concerned as we are about U.S. tariffs here in Canada, it looks like we are getting off lighter and easier than many other countries around the world. How should Canadian investors understand that fact, that idea, in light of the TSX composite in Canadian stocks?
Yeah, it seems like at least in this last round, Canada took it a little bit easier, flew under the radar. So it seems like some of the protections of USMCA were beneficial there. But of course, we do know that auto tariffs will be still significant for the Canadian economy. So we still have concerns, and we know, again, very hard to predict where things could come screaming back. But we've seen that certain elements of the Canadian equity market have shown some resilience. So, we certainly like precious metals. We like investments directly in gold, precious metals companies as well. Has been, if there's one asset that's sort of weathered this storm generally pretty well so far this year, it has been gold. So,
yeah.
We favor investments in gold, and certainly within your Canadian equity market, you do have some exposure.
In the U.S., you think investors should keep it defensive. What sectors does that involve?
Yeah, primarily in the U.S., things like healthcare, staples, utilities to a somewhat lesser degree is probably the best way to play your exposure in the U.S. equity market, as this uncertainty is still, far from over.
Chhad, thanks for being here.
Great to be here.